Alex, I got an investor. I got an investor on the podcast, so I got to take advantage of this. I need to decode some logic here. So something like as an operator, I've often struggled with is the weight that investors place on LTV to CAC. It's like such a compound metric. There's a lot going on in there. Can you explain why that metric is so important to investors?
Yeah, I get why people inside companies sometimes roll their eyes at LTV to CAC. There's many different components. You increase your price, then churn may increase, your CAC may increase. It's an output metric, but investors care, and all shareholders, including employees, should care because higher LTV to CAC translates to higher margins, which is correlated with higher valuations. So it turns out that R&D and G&A margins tend to be relatively constant across mature companies. And so if you think about what drives profit margins, sales and marketing efficiency is the most important quality. So higher LTV to CAC as a proxy for sales and marketing efficiency means higher margins, and higher margins, more cash flow, higher value. We we ran the numbers, and a 3x LTV to CAC business has a 3 times higher valuation multiple than a 2x LTV to CAC. So just one turn in LTV to CAC is a 3x higher valuation multiple. Huge difference. And even though it's an output metric, it's one that's worth monitoring.
I really love that explanation. And that's wild. Like that much value creation just from one extra turn. I think where operators struggle with it is like if they don't like the output, it's not as simple as being like, well, Bob over there owns LTV to CAC. Like there isn't one person in the org.
I mean, it is definitely an output metric, and there's, all the different components that go into it. One other way to think about it is if you invest $100 of CAC so upfront, and you're generating a 2x versus a 3x, that means you get $200 versus $300 of gross profit back. That's an extra $100 that you can reinvest into R&D, deliver a better product, invest in other areas. And so it's a growth mechanism for your business if you're able to drive higher LTV to CAC.
Alex, does the LTV to CAC ratio differ by sector? So, for example, I know you've invested in a lot of great fintech companies. Is it different versus like B2B SaaS?
So when I think about sales efficiency by segment, I'm typically thinking about it less by sector and more by like SMB versus enterprise. And part of that is because all of these metrics are gross margin adjusting. And so, financial services products may have lower gross margins, but I'm factoring that into the metric we're calculating versus a B2B SaaS tool that has 70 or 80% gross margins. SMB businesses, because they tend to have lower retention, I care about paybacks being faster because they're less likely to retain and drive returns in the outer years. Whereas if you're an enterprise product, it can be okay if your paybacks take 2 years because you're going to have 95% gross retention. You're going to have 120% net retention. And the LTV to CAC is going to look really good over a 5+ year trajectory. But if you're serving an SMB and the company isn't going to be using your product in 2 years' time, you have to juice the returns really fast.
I think it gets to the point of why it's so important to gross margin adjust your CAC payback period too, right?
Totally. I mean, if you're not gross margin adjusting your payback period, you're fooling yourself on how quickly you're paying back a customer. So imagine you're an e-commerce company and your customer acquisition spend is $100 and you sell products worth $100 over the first year. Your payback periods appear to be 1 year on a revenue basis, but if your gross margins are 50%, all of a sudden your paybacks are 2 years, ignoring retention dynamics. I think right now, in this like new wave of AI native companies and unit economics, I'm spending way more time thinking about retention. Maybe if you want me to chat a little bit about that.
Yeah, totally.
So AI companies are growing way faster than historical precedents. You may have seen Stripe published its AI customers are growing 3x faster than its SaaS customers were in 2018. You've probably seen the meme on X and LinkedIn. Companies are hitting 100 million in revenue faster than ever before. Headline like AI products, they're truly magical. But many do have a novelty factor. Users are experimenting and playing around. That's great for growth, but not always so great for retention. And so the question I have been spending more and more time thinking about is the retention curves. There's often a spike in their churn in the first few months. That's fine, even expected. But I want to see whether that curve flattens over time. And that flattening tells you the remaining customers are building habits around the product.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, lol. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.